What is an interest rate? Actually, interest rates are quite unique in terms of finance and in terms of the economy. What an interest rate is the way that people will trade money today versus tomorrow. It has to do with investors' preferences for the timing of their actual money. So obviously, I would prefer to have $100 today to having $100 next year. Everybody would choose $100 today versus next year. If I am told that I cannot have the $100 today, that I'll have to wait till next year, then what I'll want is a little extra return. Because if I had the $100 today, I could invest it and earn interest. So the interest rate is the way that the money is basically traded off between different horizons. It's the rate of trade-off, and it has to do with investors' preferences. Now, most of us know what some simple interest rates are. In the lecture note, which is assigned for pre-class and the associated assignment that's available for you, we go through some of the basic definitions of interest rates. Some simple ones that you're probably familiar with are rates like the annual percentage rate or the APR rate. And often we're familiar with those off of our credit card rates. The standard credit card rate is 18% APR. And what does that mean? Well, it means that the interest rate you're charged if you carry a balance on your credit card is 1.5% per month. So the way to get the so-called effective periodic interest rate is to take the annual percentage rate, which is 18%, and divide it by 12, the number of months in the year. 18 divided by 12 is 1.5%. So if I carry, let's say, a balance of $100, and I don't pay that $100 on my credit card for a full year, each month I'm assessed 1.5% of my outstanding balance. So after the first month, I'm going to owe $101.50. And then 1.5% is going to be charged the next month on the $101.50. And this is going to continue to the end of the year. And the end of the year, what I'm going to owe is not $118. So don't be confused by the annual percentage rate. It's just like an annualized rate. It doesn't really have that much meaning in terms of investment purposes. So 18% of $100 is $18, and I don't owe $118. It turns out that I owe more. I owe $119.60. So the annual percentage rate is not a true investment rate. It's just a quoted annual rate. The true or the effective interest rate is quoted monthly, and it's 1.5% in this case. And if I wanted to annualize that rate in terms of a compounded interest rate or a true interest rate for the year, it turns out that this is 19.6%. And the way that I would do that, and it's detailed in the lecture note, is to take 1.015 and raise that to the power of 12 and subtract 1. This is the way to get a true or annual interest rate from a monthly interest rate. So fundamentally, these interest rates tell us something about the way that we trade off money this year or next year. A bond has an interest rate, and often these bonds are paid semi-annually, so the interest rate on the bond might be 8%, 8% coupon rate, and that means on a $100 bond you get $4 every 6 months. So that's called the coupon rate on a bond. Now the interest rate, I said, tells us something about the way that we're trading off money from today to tomorrow. And it turns out, of course, that the interest rate changes through time. And we've seen fairly large fluctuations in interest rates. As I detailed in the historical behavior of asset returns, the interest rates on the simplest instrument, which is the United States Treasury bill, have varied from 0.1% in the 1930s to 17% in 1980. So interest rates can vary. And the reasons that interest rates vary really take us to the heart of what is the economic meaning of an interest rate. So I said already that it's, by definition, the way that we trade money this year to next year. But what determines the rate that we choose? What determines this preference for trading money this year to next year? Well, there's a number of factors that go into it, but there's mainly two factors. The first is what we expect in terms of economic activity. And let me be a little more specific on this. That suppose that we expected next year that there was going to be a fairly severe recession. And this would mean that my income would be reduced, I'd have a lower bonus perhaps, that my standard of living could be at risk in a recession. I might be laid off my job. I might be reorganized. There might be a merger. And generally consumers prefer to have a smooth standard of living. And if there's changes in your standard of living, you actually prefer them to go up rather than down. So this smoothing is the motive for insurance, for so-called hedging. So if this bad state occurs with a recession, a severe recession next year, what I'd like to do is to have some other investment pay me off. So this would be like insurance. Insurance always pays you off in the bad state, and it is the essence of hedging. So what's going to happen is that if we're in a plentiful state of the economy right now, that investors might decide to take their money, invest in longer-term instruments, and my example would be like 1-year investments. They might be certificates of deposit, they might be very short-term bonds or treasury bills. But investors would shift their money to hedge for sort of recessionary times. Now, this shifting of the money to the 1-year treasury bill, let's say, for example, what is it going to do? Now here, you already know from your economics courses the basics of supply and demand. As more people try to buy the 1-year treasuries, the price goes up.